your industry is at the center of a tremendous amount of growth and innovation that is propelling our economy forward. And as a result, you might find yourself in a situation where you're hitting certain financial milestones or goals or checkpoints a lot sooner in your career than you ever thought would be possible. But there's another side of working in this space that many people don't see from the outside, and that's that the hours are incredibly long. It's incredibly fast-paced. It can be very stressful and very demanding to meet the quarter-to-quarter needs that inevitably come with working at a Fortune 500 company or a very fast-growing company. And so it's very normal to look at your situation and say, am I ready to make a change? Is it time for me to take a step back? Yes, I had a great run, but when can I start thinking about the next chapter? So that's exactly what we're going to talk about today. Today, we are going to review a financial plan that we ran for a couple that was in this exact circumstance. And so we're going to show you how they are planning for an early retirement. And we're going to talk about some of the considerations that are unique and different to you if you are planning on an earlier retirement than what is typical. Okay, so let's start by reviewing our sample client. Please meet Tom and Julie Smith. Tom is 39 years old. Julie is 37. Tom is an engineer at Nvidia, and Julie stays at home with their two young kids, John and Sarah. So Tom and Julie have done a great job thus far in their career. Let's start by talking about income sources. And currently, John's income is $285,000 from salary. John also receives restricted stock unit compensation from Nvidia. We'll take a look at that here. So I just want to go into a little bit of detail on, the restricted stock unit grants that Tom is receiving. So he just accepted a new position at Nvidia and as a result received a larger grant in the amount of 3,564 shares, or based on today's share price, a little over $700,000, vesting over 4 years. Now, typically Nvidia share grants vest over 4 years, 25% per year. Tom's initial share grant does vest over 4 years, but it has an accelerated vesting schedule with 40% starting in year 1, 30% vesting in year 2, 20% vesting in year 3, and 10% vesting in year 4. Pretty typical for Nvidia to provide refresher grants on an annual basis in the amount of 20 to 40% of the initial grant. With that said, those ongoing grants, we're assuming that they vest 25% per year over 4 years, and you could see those grants listed here. So again, just summarizing, Tom's income from Nvidia comes in the form of salary, $285,000, and restricted stock unit grants. Now moving on to their other assets, Tom and Julie have done a great job of accumulating wealth. You could see here that their total assets, not including unvested RSUs, is about $4 million on the nose, and that is comprised of about $825,000 in cash, $500,000 in a joint non-retirement account vested in diversified portfolio stocks. Their largest asset on their balance sheet is Tom's vested Nvidia stock. He has about $1.2 million of vested Nvidia stock that he has not sold, and this stock is very low basis. The cost basis is about $100,000. Tom also has a 401k at Nvidia. $175,000 is pre-tax, and Tom's done a great job of accumulating about $400,000 in after-tax balances. And, that could, of course, be very helpful for him when he's later on in retirement after age 59 and a half. So again, they've done a great job of accumulating. Next, I'd like to review some of their expenses today and how their expenses might evolve in the future as well. So currently, their annual expenses are $150,000. Those are basic expenses. In addition to that, Tom and Julie shared with us that they expect that they might do a kitchen remodel. They've been thinking about doing a kitchen remodel for the last couple of years. It's sort of been a back burner item, and it is still a back burner item, but it's something that they want us to be aware of. So we don't have an assumption built into their plan for that kitchen remodel, but we have it in the back of our minds, and they share with us that there might be a couple of other projects that they want to work on. Of course, we're talking about an early retirement plan for Tom and Julia. And if they're going to do this, they want to be able to continue to enjoy the same lifestyle in retirement than as they're enjoying today and their career. So that means we're targeting the same amount of take-home income, essentially, same amount of expenses in retirement. We need to target $150,000 of take-home income. Of course, these numbers are going to grow with inflation over time. We're using the long-term inflation rate of about 2.5%, but these values are all in today's dollars. In addition to some of the expenses that Tom and Julie are thinking about, we need to think about some of the expenses that might not be front of mind for them, but will definitely be there in retirement. For example, if Tom and Julie fully retire and they aren't able to rely on employer healthcare benefits, they're going to have to go shop the private marketplace for their own benefits. So we have $2,000 a month built in as an assumption there. Once they turn 65, they'll enroll in Medicare, and we expect that their healthcare premiums will go down once they are on Medicare. So just putting it all together again here, Tom and Julie have done a great job, and really they're at a point in their career where, yes, Tom has had a great run. His work is starting to become stressful. It's starting to take a toll on him, and he wants to start planning for his future. He has two questions for us. The first question is, when can I, fully retire from Nvidia and feel very comfortable and feel very assured about the future? His second question for us is, if I wanted to take a step back in my career and accept lower compensation, but have the ability to slow down, spend more time with family, not be as stressed at work, what does that look like? How can I plan for that in a way that's responsible? And so with that said, that's exactly what we're going to focus on now, is both of those plans. Okay, this first scenario that we're looking at is answering Tom's first question. When can Tom and Julie comfortably retire and feel very assured that they can continue their current lifestyle throughout the course of their career? So let's start by taking a look at their cash flow, year-to-year cash flow. And to us, this is always a really good starting point when we are starting to plan for our future, because what a cash flow report does is it compares total expenses versus total income. And so pre-retirement, that tells us how much we might be able to save or accumulate. And post-retirement, it tells us how much in supplemental withdrawals we might need to take from our portfolio. How heavily are we going to rely on our portfolio 1 year from now, 5 years from now, 25 years from now, to help us get a sense for what we might need in retirement. So it's always a really good starting point in our plan here. So let's just get started by reviewing total expenses. Total expenses, again, include the expenses that we talked about, starting here in the beginning portions of the plan. That includes their basic expenses of $150,000. That also includes ordinary income taxes. You can see how those expenses evolve over time as they enter retirement. They're trading less tax efficient wage income and RSU vesting income for more tax efficient portfolio income from their retirement plan or from their brokerage account. Generally speaking, you'll see that expenses grow each year with rising costs, with inflation. You'll see expenses go down between years 64 and 65 when they're off of COBRA healthcare and they're on Medicare. But generally speaking, you can get a sense for how rising costs need to be built out into your plan. It's important to keep in mind that if we're planning for an early retirement, you need to be able to rely on your assets for a long period of time. So some of the typical rules, such as the 4% rule, the 4% rule was built off of 30-year retirement timelines. In this plan, we're looking at 40 years, 50 years, maybe even longer than that. And we need to make sure that this plan works very well. Okay, so we've reviewed total expenses. Now let's look at total income. And let's start with the years prior to retirement. You could see here that Tom's salary growing with inflation and restricted stock unit vests each year will be the two income sources that Tom and Julie rely on. And they result in substantial net positive cash flow in the years prior to retirement. Then ultimately, when they do retire, they're going to be in a position where they now are taking withdrawals from their portfolio. And you can see that the rate of withdrawals, the amount of income that they need, is projected to be very conservative or relatively conservative compared to their total portfolio value. And frankly, that's appropriate. That's the way it should be because they are so young when they're thinking about retirement. So it's important that we're starting from a place that's conservative because that builds more wiggle room or flexibility into their plan. However, as we continue along here, you can see that they're projected to end retirement with about $38 million. And you might ask the question, why do they need to end retirement with $38 million? Well, they don't need to, but it's important that we start on that conservative glide path because we need to account for, poor periods of market returns as well, not just average markets, not better than expected markets. But if we're going to consider an early retirement, we need to have a good answer to the question, what happens to my plan if markets return less than what I expected them to? And we're able to, provide some guidance there through what's called a Monte Carlo analysis, where we take a much broader array of possible returns, not just average returns, but we look at what happens if the market does better and what happens if the market does worse than expectations. And we do so with over 1,000 different simulations, and we can come back with a probability of success. And with a probability of success around 90%, that means we're starting at a pretty conservative place in their plan. Now, as the plan unfolds and as it evolves over time, and as we get past the early years of retirement, we can make adjustments to glide path assets to the levels that Tom and Julie would want them to be at. But at a high level, this is a very conservative looking plan and a conservative looking starting point. Okay, now let's look at scenario 2. Scenario 1, we answered the question, how soon can Tom retire from Nvidia and retire fully? In scenario 2, Tom is asking the question, under what circumstances can I leave Nvidia as soon as possible, take part-time income, and rely on my portfolio as a supplement? And so that's what we're looking at here. So the biggest change that we're making in this plan is now we have to make a baseline assumption for how much Tom might earn when he ultimately leaves Nvidia. And so Tom has shared with us that, something he might want to consider doing is being a college professor at his alma mater. And so, the average college professor at his alma mater in the area that he wants to teach in, mathematics, is actually making substantially more than $100,000. But to be conservative, we're assuming that Tom earns $100,000 in today's dollars, growing with inflation, when it's time for him to transition away from Nvidia. So that's what we have built in here. So now, income sources are going to look a little bit different in what we'll call semi-retirement. So Tom has left Nvidia, and that means he sees a reduction in his salary, and any unvested shares go away. From prior grants, they go away. He stops vesting Nvidia shares, Nvidia restricted stock units. So his income sources are in semi-retirement are his salary. And then we look at, okay, how much more do Tom and Julie need to sustain their current lifestyle? And those supplemental withdrawals are taken from their portfolio. And again, you could see here about $80,000 in growing is needed from their portfolio of $5 million. Again, a very conservative withdrawal rate, which is important. When we're planning for an early retirement, we want to be conservative. It's important that we're conservative so that you have flexibility as life continues to progress. But as a result, they're on a very healthy glide path over the course of retirement. We're assuming that Tom's wages continue to grow with cost of living adjustments of about 2%. And then ultimately, he stops working when he's age 65 in this circumstance. At that point, his portfolio has grown and he's able to rely on portfolio withdrawals and then ultimately Social Security for retirement income. And you could see substantial portfolio growth over time in this version of his plan as well. So these are two very conservatively built, versions of retirement income plans for Tom and Julie to consider. Okay, so we've reviewed the two scenarios that Tom and Julie can consider for how they leave Nvidia. Now I want to talk about some of the planning decisions that they're going to have to think about right now to plan for an early retirement. The first one is something that is really foundational and really necessary to determining whether or not you can retire early, and that's building an income bridge. And here's what I mean by that. When most people think about saving for retirement, they think about saving in their retirement accounts, their 401k, their IRA, their Roth IRA. And yes, that's a great starting point. And yes, there are tax advantages to using those accounts. But the issue is there's limitations on how you can access that money prior to age 59 and a half. And if too much of your balance sheet is concentrated in those retirement accounts, you're going to have a lot of difficulty generating the income that you need. So in this case, Tom and Julie need to build an income bridge using their non-retirement assets. So you can see, looking at their balance sheet here, they have about $825,000 in cash and $1.7 million in their taxable accounts. And so they're certainly off to a good start. They have about 2.5 million in non-retirement assets compared to about 400,000 in their Roth and $175,000 in traditional retirement assets. But they need to continue along that path. Remember, Tom and Julie have about $250,000 to $300,000 in excess cash flow. And what's different for them than most people who are going to retire on a normal time horizon is the need to accumulate substantially more in non-retirement accounts. Now, that doesn't mean that they shouldn't use 401k accounts, but they need to be conscientious the proportions that they're putting in retirement versus non-retirement. And this is where their plan looks very different. So for example, the typical Nvidia employee or the typical tech employee might want to consider taking advantage of the mega backdoor Roth rules that allow you to put a lot more money into your 401k than the typical $23,500 that most people are allowed to put in their 401ks. And they want to do that because of the tax advantages. But for Tom and Julie, it's probably not a good idea because they're going to need access to that money far sooner. Again, if Tom retires at age 48, he might need 10 years worth of income from his non-retirement accounts, or 16 years worth of income if he semi-retires at 43 before he can ever touch a dollar of his retirement assets. So that's really important. And that's how we have his plan built out here. So you could see when Tom is 47 in his last full year prior to retirement, that's exactly what we're doing. We're prioritizing spending, or saving, I should say, in his non-retirement accounts. So he's projected to accumulate about 6.3 million in his non-retirement account assets. And on top of that, he has a substantial amount of cash. And we're going to talk about that in a few more minutes. For the goals that Tom and Julie have, that's probably an appropriate mix for them. The second area that Tom and Julie need to address today is related to their largest asset on their balance sheet. That's their Nvidia stock. And not only is Nvidia their largest asset, Tom's income, Tom's salary, and the value of Tom's restricted stock units that will vest in the future are all tied to the performance of Nvidia. So this is substantial concentration risk, especially for somebody who could be retiring in as soon as a few years. And so we need to address this. Tom and Julie are aware of this, but they're also aware of the tax cost of selling their Nvidia stock, because like we said before, the cost basis is $100,000. So, what we'll probably end up doing is, in a very gradual, intentional way, glide path that position down, sell that position increment by increment over the course of several tax periods so that we control capital gains along the way. Now, what Tom and Julie need to be aware of is that while they are doing that, they are still taking on the risk of that concentrated position. Now, we would typically implement a collar stock option strategy so that we are putting a floor on the Nvidia position's downside while we are waiting to diversify that position over several tax periods. However, that's not possible here because Tom is an employee of Nvidia and his trading policy does not allow him to trade options on the underlying Nvidia stock. We also need to be aware of Tom's trading windows during which he's allowed to place buy or sell trades on Nvidia. We need to be aware of those and make sure that we are adhering to those rules. With that said, there are other strategies that we can consider to help us be tax aware and tax efficient in how we diversify Tom's Nvidia stock. So looking at his balance sheet, you see that they have about $825,000 in cash. They can use that cash, and they could also use proceeds from any Nvidia stock that they sell in the future to purchase advanced tax vehicles. There are other tax planning strategies that Tom and Julie can consider. For example, as they diversify their Nvidia stock, they can consider building a portfolio of individual stocks that mirrors an index so that it's pursuing returns that mirror the market, while also allowing them to take greater advantage of tax loss harvesting. This is called direct indexing. They can also take direct indexing to the next level by using a long-short SMA that does the same thing. Will buy stocks that mirror a broader index, but it will also use leverage to purchase even more shares short and more shares long, so that over a much wider array of environments, you're able to generate far more losses, and those greater losses can be used to offset the gains that you are harvesting from selling your Nvidia shares. So by using one of these two strategies, Tom and Julie can wind down that Nvidia position potentially quicker and in a tax efficient way. But with all of that said, we want to be tax aware, but we also want to be making good economic decisions first and foremost. We don't want the tax tail to wag the dog, so to speak. But it's important to take a big picture view. And yes, we do want to be tax aware, but we also want to make good economic decisions first and foremost. Taxes are an important part of that, but they're just one part of that. And we also have to recognize that the cost of holding a concentrated position that goes against you is almost always far greater than the tax cost of selling it in the first place. So what is the right drawdown plan for Tom and Julie? What is the right drawdown plan for you? It's going to be a little bit different for everybody, but a couple of factors that Tom and Julie should be considering are, number one, their time horizon. If they're considering the semi-retirement plan and retiring as soon as age 43, that might look a little bit different. That drawdown plan might look a little bit different than if Tom retires at 48 from Nvidia, because they simply have, more time to absorb that risk of owning that concentrated position. Tom and Julie should also be thinking about how much of that stock they are going to need to generate their core income needs over the course of retirement. How much of that capital is core to their needs and how much of it is in excess? To the extent that it's core, we shouldn't be taking too much risk with that, because if we lose that core capital, then that can substantially change your plans for your future. Now, if that capital is in excess, or if it's for a discretionary goal like buying a beach home or buying a new car or buying a sports car, then perhaps we can take a little bit more risk with that capital, because yes, we don't want to see it go, but if it does go, it's not going to disrupt your day-to-day life. Okay, we just talked about how Tom and Julie should navigate the 1.2 million of Nvidia stock that's already on their balance sheet. Now, in our third planning area, we're going to talk about what they should be doing with new shares of stock as they vest. Should they hold that stock or should they sell it? And, while that can be a very personal decision for many people, in this case, we actually see it as very straightforward. The strategy is to simply sell, because we've already recognized that they are already taking on too much Nvidia risk. And that's not saying that Nvidia is a bad company, but remember, they already have 1.2 million on their balance sheet, and a large portion of their future earnings are tied directly to the performance of Nvidia stock, and we're talking about future RSU grants. For their plan, it's important that they are diversifying that stock. Their time horizon to retirement is relatively short, and by diversifying, they are de-risking their financial picture. Now, something else that we should be aware of is that these RSUs, the taxable impact of these RSUs can change drastically with swings in the Nvidia stock price, and Nvidia, like many other tech companies, can have very volatile stocks. So, that can mean that even if you have the same number of shares investing, in this quarter versus next quarter versus last year, if the stock price fluctuated, you might have significantly different tax outcomes as a result. Now, something else that's really important if you want to maximize the value of your RSUs is the tax planning around their vests. So if you have a large amount of RSUs vested at one time, and this can especially be true in Tom's case, where a large portion of his vest is front loaded, the amount of withholding might not be enough to cover the tax liability. And this can be magnified when a company stock like Nvidia or like other tech companies is so volatile that even if you have the same amount of shares vesting from quarter to quarter or year to year, because of changes in the stock price, the amount of taxes that you owe can be very, very different during different vests. And as a result, you might have a surprise tax bill in April with more taxes owed than you otherwise thought, or perhaps tax penalties as well for underpayments. So the solution to that is you really shouldn't be thinking about your taxes on an annual basis. You should be thinking about them on a quarterly basis when estimated tax payments are due. And this isn't something that's glamorous, but it's really, really important, especially if your income can be so variable quarter to quarter because of RSU vests. So the fourth consideration for Tom and Julie takes us back to their balance sheet, and we want to make sure that they are using their assets as efficiently as possible. And we're looking directly at their cash on hand right now. Between checking and savings accounts, Tom and Julie have about $825,000 in cash. And, I understand the instinct. They have 2 kids at home. They see a remodel coming coming. They don't know how much it's going to be quite yet, but they know it's going to be expensive. And, they simply like the cushion or the safety net of knowing they have plenty of liquidity on hand that they can access. Let's look at what that cash is actually doing for them. So, the cash that they have in their checking account doesn't have very much yield at all. The cash in their savings account, however, does have about a 3.5% interest rate. And on the surface, that seems like a really good deal. However, that's a pre-tax savings rate. You have to recognize that the interest that they are paying is taxed as ordinary income. And you have to remember that Tom and Julie are in some of the highest income tax brackets, especially, while they're still working. So the interest that they are receiving could be taxed at the 32% bracket, 35% bracket, or 37% federal bracket. In addition to that, they need to think about state and local taxes as well. So that 3.5% pre-tax interest rate all of a sudden becomes 2% plus or minus after taxes. And at that rate, they're not even keeping up with inflation. Their money is losing purchasing power every year they keep it in that account. And we see that all the time where somebody keeps a lot of money in their savings account for that anticipated expense, like a kitchen remodel, but it keeps being put on the back burner and put on the back burner and put on the back burner. And all of a sudden, we're looking at 3, 4, or 5 years worth of opportunity cost that is lost as a result of keeping too much cash on their balance sheet. But there's another way that Tom and Julie can think about their liquidity needs. What if they keep an appropriate cash reserve on hand? Maybe that's 6 months worth of living expenses in liquid cash on hand, plus or minus. And what if they consider investing the rest? Well, if they transfer the remainder to a brokerage account, they still have liquidity. They could still access that money within a couple of business days. Yes, it is going to be invested, so the amounts could fluctuate, but they have access. If they invest the remaining cash in stocks, they might expect a higher return over longer periods of time, and those returns will be taxed but with more favorable capital gains tax treatment versus the ordinary income treatment of interest income on high yield savings accounts. Now, the natural question is, what about the remodel? What about any other big expenses that they might anticipate coming? And, that's where we can employ other strategies such as a line of credit. Tom and Julie could either establish a home equity line of credit or a securities-based line of credit on their brokerage account. And that allows them to invest their cash while still having access to an alternative form of liquidity. And this works particularly well during their working years while they do have a high income and while they are receiving those RSU vests that they are selling, periodically. So instead of sitting on, $825,000 of cash, they might sit on a fraction of that, invest the remainder, and let that money work harder for them. And then if they do need additional funds for a remodel, they can draw on that line. They can access their line of credit. Then as future RSU vests come in, and as they are selling those vested shares, like we discussed a couple of minutes ago, they can use those RSU vests and that cash that they have on hand now to pay off the line of credit very, very quickly. So this strategy can work particularly well while they are in their higher income earning years of their career. So the net result is that their money is growing at a higher rate and taxed more efficiently during the years they don't need it. And that can have a substantial impact on the trajectory of their plan. So, how much of an impact that they can have. So while it can seem like a small adjustment, you could see here by, making that, by investing that cash and allowing that money to work more efficiently for them, Tom and Julie are projected to have $172,000 in greater portfolio value at the time that Tom would be fully ready to retire from Nvidia, and that only bolsters their retirement income plan. So again, it's not about taking on unnecessary risk. It's not about taking on unnecessary leverage. It's about not leaving money on the sideline when it could be working harder for you. Okay, finally, a little bit ago, we talked about how much Tom and Julie should be contributing to their retirement accounts. Now we're going to talk about, with those contributions, what tax treatment should they be receiving? Traditional pre-tax or Roth after-tax? And the answer might surprise you about Roth accounts. Yes, there can be a lot of benefits to receiving tax-free growth and tax-free withdrawals in retirement. But ultimately, it's a matter of, are we going to be paying more in taxes today, or are we going to be paying more in taxes in the future? And to that end, we, want to look at exactly that. We want to look at projections of Tom and Julie's tax liability over the course of their retirement. So, you could see here that each one of these bars represents Tom and Julie's tax liability in each year of their career and then later on in retirement. And you can see here that, frankly, when they retire, their tax liability is dropping off a cliff. And that's because even though they're targeting the same amount of expenses, the same lifestyle, their income, number one, is going to be a much lower number. They're going to have a lot less income. Number two, their income is going to be taxed far more tax efficiently. They're going to be trading tax inefficient income sources like wages and like RSU vests, and they're going to be using far more tax efficient sources like withdrawals from a brokerage account. And the gains in those brokerage accounts are generally taxed at more favorable capital gains tax treatment. So, looking at this picture, you can clearly see that right now, Tom and Julie are in the highest income earning years that they will likely ever be in for the rest of their life. So right now, they're probably better off receiving the tax break today, deferring taxes by contributing to the traditional retirement account and letting those accounts continue to grow tax deferred into the future. So as you can see here, Tom and Julie's income is really high. As a matter of fact, it's probably the highest that it will be for the rest of their life. And so with that said, it makes a lot more sense to make traditional contributions to the retirement accounts and receive tax deferral today than pay taxes on that money when they take withdrawals in the future in retirement when they're in much lower brackets as well. The tax planning doesn't stop with the contributions that they make to the retirement accounts. When they retire, when they stop working at Nvidia, again, they're going to be in very, very low tax brackets because they're just taking withdrawals from brokerage accounts. And then later on in retirement, when they're required to take RMDs, required minimum distributions from the IRA account, that's when their income jumps up again. So as you can see here, Tom and Julie are in their highest income earning years today that they'll likely be in for the rest of their lives. And so that means that really the answer to the question is they should be making traditional contributions. They should be accepting tax deferral today so that they pay taxes on withdrawals in the future when they're taxed at much lower brackets than they are today. But that's not where the planning stops. That's actually just where it starts, and really where it starts to get interesting, because you could see here as Tom takes a step back from work at age 47, his income drops off a cliff, and that's because he and Julie are entirely relying on portfolio withdrawals for income. So it's during that period when they're in really low tax brackets that they can start to consider some Roth conversions. They can convert traditional 401k dollars to Roth at a much lower tax rate than they would have paid if they had contributed to the Roth during their peak income earning years. So in essence, the strategy is to contribute to the traditional 401k now while the tax savings are the largest, and then convert to the Roth when the tax cost is the lowest. So you get the benefit on both ends. The deduction when you're in your highest income earning years and the conversion when you're in your lowest income earning years. And that is a significantly more efficient strategy than contributing to a Roth in the 35 or 37% bracket today. And if we look at the other scenario where Tom and Julie are considering semi-retirement, it's going to be, much the same, except, that window to do Roth conversions might be bumped out much further into the future, into these years here. Because remember, now Tom is receiving about $100,000 in wage income in today's dollars. And as a result, they're in slightly higher brackets until Tom ultimately does retire and he and Julie elect Social Security before required minimum distributions. So let's take a step back and talk about both plans again. Both plans, whether Tom retires in 2035 fully from Nvidia or just takes a step back and semi-retires in about 5 years in the year 2030. So as we conclude, I think it's important to point out that both of these plans work well. There isn't necessarily a better or worse option or a right or wrong option. It's simply a matter of Tom and Julie's priorities. So for example, would Tom prefer to be in a position that he can fully retire when he ultimately does leave Nvidia? Or on the other hand, is it more important to Tom that he's able to leave Nvidia as soon as possible? Whether that's because the nature of his work is so taxing that he feels the need to leave, or it's because he's simply so excited about pursuing other things, such as, being a college professor at his alma mater, that he wants to leave as soon as possible. So, our recommendation to Tom and Julia, before we get into any of the tactical things that we pointed out can help them optimize their plan, our recommendation would be to get clear on your goals. What are your goals? What's important to you to accomplish over the next period of time? And then all of the other decisions that we're talking about here, such as how much of an income bridge Tom and Julie need, what they should do with their Nvidia stock, and over what time horizon should they de-risk it, tax planning around an early retirement, what they should be doing with cash on hand. All of these tactical level decisions will become more clear for them once they get a sense for what ultimately they want the next chapter of their lives to look like. And so that's the key takeaway. All of those tactical level decisions will become more clear as they get more clear on what they want the next, portion of their life to look like. Yes, they've done a great job of accumulating. Yes, they've done a great job of putting a foundation in place, but now it's about organizing that foundation into a plan that aligns with their vision for their future. So if you're a tech employee who's thinking about an early retirement from their company and you'd like to think it through with us, visit hapfinancial.com and we would be more than happy to help. Thank you so much for watching.